Welcome to Real Talk Real Estate. What's going on, Real Talkers? This is David Greene of The David Greene Show with Christian Batchelder of Mortgage Mondays. Christian, what's going on today?
Not a whole lot. Somewhat uneventful news-wise in the mortgage space, but we're going to find some real fun stuff to talk about. So excited about this one.
There is always something to talk about when you live in the crazy world that you and I live in. As we were just discussing before we started recording here, rates have actually started to tick up a tiny bit from where they've been. It looked like they were on the way down. A lot of people jumped into refi. A lot more people said, I want to wait. I think that they're going to go down more. On our last episode, we said, hey, that's not always the best bet. Sometimes it's better to take what you got and then refinance again if they continue to improve. And it looks like that didn't happen. So what have you been seeing going on in the industry as far as rates at, and the people that have that waited to refinance, where are they at now?
And if you guys follow current events, so if you go back to when the Fed cut the basis points by 50 bips, that was an expected outcome, right? That's kind of what the industry had a consensus on that was planned to happen. And if you track back, 2 to 3 months prior to that, you guys will see a significant rate drop. But on the day the Fed cut the rates, not a whole lot of motion happened. And to kind of bring this into clarity, the good thing to understand is mortgage rates price based on news and projections, not based on action. So when the Feds actually drop rates, a lot of people say, I want to wait for that day to get my loan locked in. It's not going to help you. The banks are smart. Banks don't just wait for the Fed to make their appearance and say, hey, here's 50 bips. And then all of a sudden, all the banks cut their mortgages by 50 bips. That's what the general public thinks.
Right.
They think that's how it happens. It's not. Usually there's a kind of trickling down the 2 to 3 months prior to that, where you do still get a savings over those 2-3 months, but it happens leading up to the event, not on the event. And to answer your question, David, since that, we have these little things that come out. We have the CPI numbers, we have the jobs report, we have basically all these little press conferences, right? That the Fed, different portions of our economy put out. Whether they are or they aren't super accurate, we're going into an election year, so obviously certain people look better if there's more jobs out there, right? Mm-hmm. And not conspiracy theorists, but this is just a very real thing. The jobs report was a couple weeks ago now, came back, economically speaking, better than expected, but for mortgages, worse than expected. That basically just means more jobs were created than we projected, right? So the mortgage rates we're expecting, when very few jobs are created, typically we cut rates to stimulate the economy. When a lot of jobs are created, laws of supply and demand, right? There's more money going around, everybody's employed, cut the interest in mortgages, which means increase rates. And that's what happened. So that's a really good example of when a really strict movement can happen on the day of the announcement, is when it goes against what's expected. So for instance, we were talking about the Fed day where they cut 50 bips. If the Fed decided to not cut rates on that day, we would have had a massive surge in interest rates. It would have gone way up because their motions directly contradicted what was expected. If they just do what we expect, there's not really much of a change, though.
So let's unpack that a little bit. The Fed announces what they are planning to do oftentimes before the meeting comes out, where they say this is what we are going to do. The mortgage industry anticipates if the Fed says, for instance, we're going to lower rates, and they go, okay, they're going to be lowering the prime rate. So why don't we go ahead and start to decrease the interest rates that we're offering the public in anticipation of that? Then if the Fed says, you know what, we're not going to lower rates after all, the industry may respond to that and say, okay, let's push them back up because they didn't do what we thought we were going to do. But if they do lower rates like they said, the rates have already come down for mortgages. They anticipated that. They don't say, oh, the release is here, let's drop the pendulum and let the rates get cut, right?
That's absolutely right. Yeah, and that's why everything, like such a big portion of my industry that goes into how we service our clients, is tracking these things, right? We try to stay on the ball. We try to see what the Fed is saying. I listen to every Fed meeting, as boring as that sounds, right? Everybody just cares about like the 50 bip cut. But Jerome Powell talks for like 2 hours, right? A lot more than just the 50 bips is spoken about. He talks about where the projections are going, where they feel inflation's going, what they're going to do to combat it. There's a lot to unpack there. And that kind of, as my industry as a whole starts to develop, those goals that we set. Oh, he's going to do this, he's going to do that. And that's what impacts pricing. And sometimes we're wrong, right? So a good example is this jobs report. 90+% of the mortgage industry was under consensus that the jobs report was going to come back around 100 I believe it was 125,000 new jobs created in America. I think it came back at like 280. It came back more than double what we expected. That had a big surge to interest rates because the economy is like, whoa, there's more jobs than we thought there'd be. What's going on? Right now, we can argue on the validity of the report, but regardless, the market still follows the numbers, right?
All right, let's share a little bit about what we think is going to be happening in the future. So it looks like, okay, you can see my screen here. The San Francisco Fed president said she sees 1 or 2 more interest rate cuts this year. Now, correct me if I'm wrong, Christian, but the Fed has said we are going to continue cutting rates for this year and beginning of next year, right?
They have said that's the direction. They haven't committed to specific cuts yet. They do anticipate a continual trickling down of interest rates through the next 2 years. That's correct.
All right. And San Francisco Fed President Mary Daly said on Tuesday that she's open to skipping an interest rate cut at one of the Federal Reserve's 2 remaining policy meetings this year. So they've said, yeah, we think we're going to be decreasing them. But now Mary here is saying, hey, we may not. We don't know that we have to do that. And that's because when the jobs report looks bleak, they feel like we have to lower rates to stimulate the economy. Well, when the jobs report is strong, they don't want to lower rates more because it can stimulate the economy too much, which creates inflation. So you mentioned something about the jobs report earlier. Can you clarify what you saw in that report?
Yeah, basically the one as of 2 weeks ago, early October here, more jobs were created than were expected, which is a sign of a surging, economy, right? Which probably isn't a true representation of where we are, but I digress.
But that's what you were getting at earlier when you mentioned, hey, we have an election coming up. The current elected officials may want the economy to look stronger than it is in order to
it looks
get
good
confidence
if,
from more votes.
250,000 new jobs were created in the last month.
Right.
I mean, that looks good. It doesn't help interest rates, but it is a sign of economic strength.
All right. So now if we are having more jobs created, which is what the report says, that may lead to the Fed saying, you know what, we're not going to cut rates, even though we thought we were going to, right?
That's absolutely right. And it's funny, this article of what you're reading here, David, let's say 2 or 3 of these come out from some prominent figures in the Fed, right? Some interviews they did, some articles they wrote, whatever. This would move rates more than the Fed's decision, which sounds bonkers, right? It sounds hilarious that just like a simple news article would have a bigger impact on the market than like the actual day the Fed makes their decision. But that's because these tell the projection story, right? These tell what is going to happen, which is what impacts rates. That news cycle is what banks try to get ahead of things with and price accordingly. So if a couple Fed chairs or if a couple different, Fed members or, prominent, elected officials or whoever it is coming out with a similar concept of this is that, hey, we may not have another Fed rate drop this year. That's going to have an upward pressure on rates, which, shocker, it's what we've seen the last couple weeks. We have absolutely had upward motion of rates, really starting at that jobs report and kind of stemming since then. There's been a consistent tick up in your average mortgage rate.
And that is the opinion of this show, Mortgage Mondays. We tend to weigh the anticipation of where rates are going to go more than when a Fed actually announces something. Now, again, nobody ever knows this for sure, but that's why you're listening to a show like this. A big part of the interest in Mortgage Mondays is, where are rates going? Should I buy now? Should I wait? Should I refinance now? Should I wait? Because as we know, interest rates often affect housing prices and really more importantly, housing demand. So that gives you a better idea if you're going to get multiple offers on that house you want or less offers on it. And this is important to us because if they're saying, hey, we may not actually cut those rates like we originally said we were going to, it's not a guarantee, but that does lessen the likelihood that rates are going to be lower in the future. So with that in mind, if someone's been sitting on the fence about a refinance, let's say that they're at about 7.5 and they thought, oh, rates are going to go to the 5s, I want to wait. What would you tell that person?
Yeah, that's the tricky part. What I'd say is if there is an objective benefit with a fairly good break-even time. I mean, just for instance, let's say it's cost $5,000 to do your refi, and you can drop your monthly payment. I'll just do easy numbers here, $250, right? So for a $5,000 cost of your refi, you can save $250 a month. So if we just take $5,000 and divide that by 250, you have a 20-month break-even period. That's what?
Yeah,
a little less, about a year, about a year and a half, right? You have about a year and a half break-even period. Show me an investment that has 100% rate of return, 100% ROI in 18 months. There's not very many out there, right? Maybe you get lucky and you hit a penny stock, Wolf of Wall Street style, but that's probably not going to happen, right? So Does that mean you failed if you refinance again in a year? Not necessarily, as long as there's another objective benefit, right? What a lot of people I talked to said, hey, Christian, I want to wait until the Fed, drops rates in November. Well, look what they just missed out on, right? They could have refinanced now, taken their 7.5 to a 6.25, and now they're looking at rates potentially going back up to 7, and there's no savings there. And all that time, this 20 months in this example, is now lost time. Now, if something happens in the next 12 to 15 months, sure, they can take advantage of it again. But if a refi makes sense for you now, I always say take it. It just makes sense if your break even is reasonable. And if it's not, like if you're going to refi, don't refi to shave off 0.25% on your rate. It doesn't make sense. It's not going to break even fast enough, right?
Right.
But if you guys are sitting at 8.5, 7.99, refi, right? And if we look 12 months in the future and now you can get a 4.99, cool, refi again. But you should lock it in while it's there, because just like everybody expected it to continue tricking down the end of this year, it's not, right? We tricked back up. So exactly what David and I have warned about on previous shows of this, even when we were hosting it on BP, we're seeing it in real time. This is why we say take advantage of it while it's here, because no matter what the consensus is, everybody and their mother is saying we're going to drop rates over the next 2 years. Well, this last month we haven't. So that's wrong, right? So lock it in while you can is my advice.
There you go. And if you would like contact information on how to get a hold of Christian so that you can get some advice on if you should refi, but more importantly, which loan to refinance into and what rate would be the best for you, stick around to the end of the show because we're going to share that shortly. All right, our next article here is that mortgage rates are sideways to slightly lower. So they were going down a lot. They started to come back up. Now they're kind of leveling off, maybe dropping down a tiny, tiny bit. It says the average mortgage lender is quoting rates that are just a fraction of a hair lower today compared to last Friday. Lenders were either closed or otherwise not able to update rates yesterday due to the Fed holiday. Anything other than higher is a victory recently. Rates jumped at the second fastest pace of the year after the jobs report that was released on Friday, October 4th, and continued moving higher through last Wednesday. That's what Christian was just referring to. They've calmed down since then, but they haven't made any meaningful progress back towards the lower levels that were seen a few weeks ago. Now, context here matters because in the short term, it would be easy to lament the fact that rates are up about 0.5% in a month. But if we look back to early April, rates are still down the better part of a whole percent in year-over-year terms. The improvement is about 1.4%, almost 1.5. That's a very solid pace under any circumstances, but especially in the absence of the onset of a recession, which is usually when you see rates dropping, is when we're in a recession. Now, Christian, you see a lot of things. You own real estate. You close deals for people that are buying real estate. You close deals for people that are refinancing real estate. What's your opinion on if we are in a recession that is not being talked about, or if we're not in a recession?
That's a good question. I think one of the contributing factors is unemployment, which our unemployment, admittingly, is very low right now. But I have one problem with the jobs report, and from what I see, David and I get a very unique stance on the economy, in my opinion, is because we talk to employed people who have enough money to invest. That's a very rare subset of the population. 80% of America probably does not have comfort money to invest confidently, right? Like they need to pay their bills. They're living paycheck to paycheck, right? And they sure as hell don't have a down payment for a rental property, right? We'd like to fix that. We'd like to preach financial, education and increase that percentage of people who can be homeowners. But when things like, we're on this topic of the jobs report, right? Which is one of the contributing factors to what we would classify as a recession. If somebody gets fired or laid off at Facebook making $500K a year,
yep,
and they go pick up a job working at Pizza Hut, delivering pizza, they are a net neutral on the jobs report. That's an added job to the economy.
But what does it do to the GDP?
But what did it do? Exactly. You lost a $500,000 worker and got a $50,000 worker.
Yes.
That, in my mind, it's a very, in a bubble situation, but that's a personal recession for that person, right? Now, if any of you guys know a bunch of, we're in California, we have worked with a number of tech people, and, that's usually one of the industries that drives the economy because of how much dang money they make, right? But if we're starting to bleed those people, and you guys go look up articles, Amazon layoff, Facebook layoff, Google layoff, Apple layoff, like these super huge high earners who are the market movers, a lot of them are being laid off, right? And there's less money to go around with them. And I think that's a sign of maybe a recession in a bottle. I don't think, with the way that, the Fed operates, I think nowadays it's harder for us to go into a recession than it's ever been. Just because of the fiscal policy that we have, print money. But the downside of not going into a recession is inflation. It's exactly right. So, whether or not we can dance around, I mean, you always hear politicians dancing around like, what's the technical term of a recession? And they kind of say like, well, we haven't really reached this metric yet, but we've reached 4 of the 5. Regardless of like how we want to classify and categorize a recession, you can feel the impact from people, right? I'm doing pre-approvals for people that qualify for less than they did before, right? I'm doing pre-approvals for people who don't qualify anymore when they would have in 2020. And I think the downside is, somebody who's saving up their down payment who now has 3 times the cost of their groceries. That may not be technical terms of recession, but that's a huge financial impact on most American families. And I don't really like the idea of dancing around all these terms. I would just say, I think many, many people are feeling the negative side effects of our fiscal policy over the last decade, really.
Well, if you measure a recession by how much money you're making, it may look like it's down a little bit because you're making less money, but you still have a job. If you measure it by the purchasing power of your money, we're absolutely in a nasty one, because even though you may be feeling like you're making the same money every year, how much that money can buy is going down significantly.
That's exactly right.
Which is just a tricky way of ushering in a recession and your wealth being stolen from you without you realizing it's happening. My personal opinion has always been, it is worse when you have inflation than when you lose your job. Because if you lost your job or you took a pay cut, you would respond with a lot of urgency. Your comfort zone wouldn't be as important to you. You'd be scared. I need to get a job. They cut 20% of my pay. But if everything becomes 20% more expensive, it sneaks up on you. You don't realize it. It's like carbon monoxide instead of an actual fire where you can see the smoke. And I feel like that's where our country has been for a long time. And that's why people's debt are going up. Their credit card bills are going up. Their comfort zones are still intact. People are still living more or less under the same quality of life that they had before. But their personal wealth and their purchasing power is significantly down. And you and I feel that working in the sales industry. We know that to make the same amount of money, we're doing twice as much work. We see that the type of deals that are closing are significantly cheaper than what they were when rates were lower. We were closing a lot of $800,000, $900,000 deals. Now you're closing a lot of $300,000, $400,000 deals, because housing has become so expensive that people can't buy. We see the places that loans are closing in. We were doing, this is a technical term, a buttload of California deals in the past that were very expensive. There you go. Because we were at 3% interest rate. So you could buy $1 million house. It was going to be worth 1.3 in a year or two. So you felt good about it. Now we're closing a lot of deals for people in Ohio, Indiana, Alabama, some of these cheaper markets, because that's where people are moving to, or that's where the money is moving to try to find some safe place to be. So those are all signs that a country is not doing well, that we're losing money as far as the economy is concerned. And there's less transactions in general, which we bring up, or at least I bring it up, because when housing prices are not dropping, you get lulled into this false sense of security that the economy is doing well. But if a quarter of the houses are selling that we're selling, you're generating a lot less income for the government. The GDP is going to be down a lot. There's less income taxes being collected on these professionals that are involved every time something in the housing market changes hands, which is very significant. So from our perspective, I think we're functioning like we're in a recession, even if we are not defining it as one. Now, Christian, let me ask you, we'll take a little bit of a segue here. Personally, I've got you working very hard over there. I believe your fingers are becoming gnarled from typing. Your voice is cracking from talking all the time. Yeah. What's it like in your seat at the one brokerage right now? How busy are you?
I'm definitely busy. I'm 50 plus in submission as an individual loan officer right now. We got, I think, closing in on 200 total as a company, which is, fairly up, middle of the pack, maybe slightly above average for us as a company. So, volume, I have seen an uptick, but it's delayed, right? So we're now getting all the people who reached out because the rates dropped. Because it takes people 2 to 3 months to go into contract, right?
Yeah.
So the rate drop spurs a lot of interest. Then they go out and look for properties. Then they find something. Then they negotiate. Then they get an offer accepted. Then they close, right? And that takes, that there's delays there that kind of step down, through 2 or 3 months sometimes. But I'd say, I mean, business definitely picked up from the rate. I think it will continue so. But I also think, as you were saying, David, I think one of the biggest things I've noticed is a lot of people have a different idea of money. I was thinking about this the other day. Like when I was young, if somebody made like $80K a year, it's like, whoa, like good job, dude.
Oh yeah, right.
Good job. Like that's you're kicking butt. Now somebody makes $80K and it's like, you work at like Subway. What's going on? Like you're like, I mean, granted, in California, this isn't nationwide, but in these markets where a lot of these investors are driving the purchasing power. Just like David said, we deal with California investors that buy in Alabama. Like they're the driving force that's impacting the market. They can't invest with 80 grand if you live in California. It's impossible. You're not buying anything. Your cost of living is eating your paycheck to paycheck at 80 grand, right? But that's that secret killer that people submit their loan applications all the time to me. And back in 2020. They bought a house making 80 grand. Now they're like, oh, I want to buy a rental. And it's like, you don't qualify for anything. And they're surprised. It's like, oh, but my income hasn't dropped. And I was thinking about that when you said that, David. It's like the silent killer. Sometimes losing your job may honestly be better than having everything go up by 20%. Because it's like, you can't replace everything going up by 20%. You can replace a job. I mean, obviously that's work and you got to apply. And that's strained on people. But man, when all this goes up, you still see that same dollar amount coming into your bank every month. It's just a larger amount going out. That's brutal. Yep. That's it's dangerous unless people develop a new concept, of money. Your parents didn't think of $1 million the way we think about it today, right? Like,
well, let's take this in context. What do you think the average car payment is for someone who wants to buy like a new Honda?
Oh God, I see them all the time. $400 to $600 a month.
Yeah, that used to be like $80 to $120.
Yeah, my mom's Honda payment when I was a kid was $99 a month. That's exactly right.
Right. And so if cars have become 4 times more expensive, but wages have not increased by 4 times, if food has doubled, but wages haven't doubled, you see where we're getting at here. If people are not taking their wealth building seriously, if they're not taking, more important, their skill building seriously, if they don't like working hard, if they're in this constant protection of their comfort zone, I think that they're going to be losing their quality of their life. They're going to be falling deeper into debt. And the country as a whole is going to be taking on more debt, which means inevitably we will print more money to pay for it, and it will create inflation. And Christian, what is the best place that you know of to protect money in an inflationarily ripe environment?
Yeah, I mean, of course it's real estate. I mean, real estate, it's the rising tide, right? It rises real estate up with it. It's a hard asset. It's tied to the most basic human need, which is safety and housing, right? I guess maybe outside of water may be a little more basic than housing, but it's up there, right? I don't know if any great water investments, maybe there are, but also the tax benefits. I had this conversation with the CPA the other day, and I asked him, I said, where do you think it breaks, right? Like, David, this perpetual thing you just got into, like, we raise stuff too much, then we raise inflation, and then we can't really raise wages. Like, at some point there becomes an imbalance where it's just not gonna be able, it's not sustainable.
Not sustainable.
Right? Yeah, you're not gonna be able to keep doing it. And that's something I've been thinking about a lot lately. And he said he thinks the answer is just going to be increased taxes. That's how they're going to, probably drop the cost of a lot of things. They'll just tax you more and they'll government subsidize stuff, but they're going to do it via taxes. Now, what's the best investment class or asset class to avoid taxes? So it's like, I'm thinking ahead to like, man, if they do crank, what if your income tax is 60% now? What if it is? I mean, this isn't like a maybe, when the income tax was created, it was to fund a war. It wasn't meant to stay.
Right.
The income tax in America was not something that was in the 100-year plan for us. It was in like a 15-year plan. And of course, the government started to like having so much money to throw around, and they kept it. But we're not supposed to be taxed employment and income and property and state and gas tax and transfer tax and capital gain. Like, the same dollar gets taxed 15 times now. Why not have it get taxed 16 or 17 times from the government standpoint, right? I think that's a very real possibility where we're going, and there's only one class of assets that allows you the best advantages to fight taxes, and that's real estate. And that's why I am very bullish on continuing to build both my portfolio and advising our clients to do the same.
Well, you've got 50 people in submission right now that you're either saving them money on existing debt or you're helping them to build wealth by taking on new debt to buy real estate. So thank you for your service, Mr. Batchelder. If people want to reach out to you, they want to get a hold of you, they have to refinance their house, they want to refinance their house, or they want to buy real estate and start building wealth, where's the best place they can do so?
Yeah, our company's always accessible at theonebrokerage.com. That's our general landing page, our website. If you want to reach out to me, Instagram's usually the best way, at @theonebroker. Is my handle. And Dave, what about you? What if they want to reach the big dog?
They can find me at davidgreen24 on Instagram. They can find me at david@davidgreen24.com for my email. And they can find us, like you said, at theonebrokerage.com or davidgreen24.com for my website. Definitely go give Christian and I a follow on Instagram. We post as much helpful content as we possibly can. And make sure you subscribe to the David Greene Show as you're watching this today to get notified every Monday of a Mortgage Monday, every Tuesday of a Seeing Green podcast, and every Thursday of an interview style podcast. We're doing everything that we possibly can to bring you as much value and knowledge as possible to help you build your wealth through real estate, to fight this common enemy of inflation. I got this vision when you were talking, Christian. Like, remember watching, I guess your generation would have been the Power Rangers.
Mine would have been I love the Power Rangers, right? Man. That stuff's cool.
You guys make me sick.
Remember how they always had the bad guy would show up and they would get really big and huge, and then that would be like inflation, right? We can't beat this monster. And then all the Power Rangers would have to combine their forces and then make themselves really big, and then that's how they go fight it. That's kind of what we're doing with Mortgage Mondays and the One Brokerage and Spartan League and the David Greene team. We are trying to form a big enough fusion to take on the enemy of inflation, because it is a monster and it is stomping people out everywhere. So let us know in the comments if you are worried about inflation, if your cost of living has gone up, if the purchasing power of your dollar has gone down, and what you're doing to fight that. Now, before we get out of here, we are going to have a very quick word from the Mortgage Mutt.
So we got little Cinder here.
Cinder the Mortgage Mutt.
The Mortgage Mutt. Big refinance mogul right here.
Yes.
And he says, save money on your mortgage.
That's what we're here for. And this is why you subscribe to this channel, because where else are you going to get a cutie pie like that? All right, everybody, we appreciate you. Thank you for the follow. We'll see you next week on Mortgage Monday.